all the same. It's the price points where the buyers or the demand outweigh the sellers, or vice versa. Consequently, the market maker has to go make the market and match everybody up. Okay? So where do these things occur? Look at this trend. We got this sharp, sharp downward cycle of trend happening here. But notice the fascinating fact that these selling points are actually occurring on a horizontal resistance level. Now, this is interesting. Why is it interesting? Because very often the trend line actually coincides with the horizontal support and resistance. In fact, I will tell you that I believe horizontal, that is from left to right, horizontal support and resistance is much more important, in my opinion, than diagonal support and resistance. The trend line diagonal support and resistance is very important. We need to know where it is, but it's the horizontal price points that become the pivot areas where the traders take the stock to. Why it happens, I honestly can't tell you why it happens. I just know it happens, and I've been able to work with it for a long, long time, and you guys have seen this thing happen. All right, very, very interesting. Now, here's another interesting thing. Sometimes we don't have a hard price point. In fact, more often than not. More often than not, one of the biggest mistakes that I see of beginning traders is the beginning trader gets frustrated that their support and resistance does not work to the penny. Well, ladies and gentlemen, support and resistance is not supposed to work to the penny. It's a general measure of trend. It's a general measure of sentiment. And a lot of times what happens is we actually end up with what I refer to as a support or resistance zone. We've got a beautiful one on this trade right here. Notice if we connect these points, we've got one line right in through here. Okay, that's one level, but we've got peaks right up here and here and here and here that need to be connected. So we end up with two lines, but they're very, very close together. And people say, well, Jeremy, I got all these lines drawn. I don't know which one to follow. Well, if they're that close together, you can almost look at them as one line and say, this is going to be my support zone. This is going to be my resistance zone. Somewhere in here is where that resistance is going to shape up. And you need to be conscious of that and be aware of it, because a lot of times what will happen is students will try to make it to the penny, and you can't make it to the penny. Sometimes it's a whole trading range. In this case, that's a trading range of several dollars, probably $10 or $12. Okay, and so that doesn't become a trading range as in a channel. It just becomes a very large trading zone or support and resistance zone. Be aware of that. Take a look over here at this particular trade. This is a beautiful channel that we had on CSX, but notice that it was not to the penny really tight. Instead, we actually had a support and resistance zone both on the top and the bottom, and the one on the bottom ended up really being 3 support levels that created the entire zone. So you say, well, which price point are we trading to? And I have to say, I don't know. We never know. The job of the trader is not to be a prophet. The job of the trader is I should say the technical trader, the job of the technical trader is to put boundaries on the market, anticipate the next move, and trade to a logical target for a profit, but not necessarily saying this is exactly where it's going to stop. We don't know exactly where it's going to stop. That's not our job. That's not what we care about. We're not trying to get every penny of it. We're just trying to get a consistent profit. And if we can consistently recognize opportunities like this, then that's all we're hoping to get. And so you have to recognize that sometimes there's a zone. In the case of this top section here, we've got 2 price points right in through here. I'll just mark them with a bullet, and then we've got the ones that were on the top here. Okay, and in the case of the bottom one, these were the most bottom ones, and the extremes are going to be the least likely to be hit, obviously. Then we had support right in here, and then we had this range right in through here where we were coming into play. Now, there's also another thing that you notice in here, and maybe you didn't notice it, but I'm going to point it out to you, and this becomes a less important support and resistance line, but equally valuable. Less important, but equally valuable. And here's what it is. It's what I call an internal line. There's a line running through here. It's evident that we do have some sort of support and resistance occurring at this price point, but it's outside, or it's actually inside. It's not being confined by the channel. The channel's not confining it, I should say. Obviously, the support and resistance is working in there, It's just not part of the channel. Does that make sense? So this would be what I would call an internal line. Now, internal lines can mess up your trade. They can really mess your trade up, but they're not as important because the stock does not adhere to it nearly as tight. You see what I'm saying? When you get a really good support and resistance area, the stock's going to be pretty good with it. But whenever you get an internal line, it kind of becomes an internal pivot area. It can create these moments where stock, for example, in this case, we traded up to here, back down, and then it finally went on up to the top of the channel. So you see that? Now, a lot of times what would happen is people will look at this and they'll say, I can't figure this channel out. And what I want to show you is, nope, there's very clear, definable trading behavior. You just have to look at it a little bit differently. Does this make sense? Makes sense to you. Sorty says, what does it mean when you say it's not part of the channel? Well, notice what's happening here. The channel boundaries are really going like I'm drawing them right here. You see, these are the channel boundaries, the extremes of the channel. That's the channel itself. But this internal line, it's happening internally, but it's not the boundary of the channel. So it's inside the channel. It is a pivot area in the middle, but it's not part of the boundaries of the channel. Does that make sense? I mean, it's kind of what I just said, but hopefully maybe hearing it again, it makes more sense. Okay, so now, understanding this basic psychology, how do we apply this and where does this build in terms of our understanding of trends and then ultimately where we're going from here? Okay, so understand there are various types of trends. There's actually 3 types of trends. And a really good definition here is that trends define a direction in price. The direction in price. When we refer to a trend, we describe a directional trend, one of rising or falling prices. So usually a trend is either going up or down. However, we also have a third type or a third classification of trend, and we call that a sideways market or a neutral or a trading range. So technically there's 3 types of trends. However, the popular term for trend is either a rising trend or a falling trend, either a bullish or a bearish market. That's the popular term. But from a technical standpoint, we also would classify a sideways market as a type of trend, but instead of being a bullish or bearish trend, it's a sideways trend. So we could with just as much validity, we can sit here and say the market is trending sideways. And in fact, a lot of times you guys might have heard me say that in Power Trader or one of my other analysis classes. So let's talk about how we identify these trends. Trend identification is exceptionally easy. And I really think that all of you at this point already know this because of our line discussions that we had in level 1. But I'm going to hit on some of these topics anyway, just so that it will hopefully solidify the concepts for you. We identify trends based on what we would refer to as peak and trough analysis. Now, I have never used those terminologies with you up until now. Not that I didn't know them, I just chose not to use them. Sometimes you'll hear us refer to them as peak and valley. Same thing. The idea of a peak and a valley, a peak is the price point where the stock peaks in price. It's very simple. The price point where the stock peaks in price versus the trough or the valley is the price point where the stock bottoms out. You've heard me refer to these as swing points. You've also heard, more commonly, I call them support and resistance. That's because any peak or any trough or valley is a single instance of a support or resistance. And whenever I taught you to draw support and resistance, what did I do? I said, go to the turning points. Where did the stock make a turn? That's going to be a turning point or swing point. That's also either a peak or a trough, or a peak or a valley. So we're going to go ahead and mark our support and resistance lines along these points, but the reason that maybe you haven't heard it as much is because I'm teaching you to draw support and resistance where we're having at least multiple points line up. So now I'm kind of bridging this gap together so you can see how the whole thing fits together. In an uptrend, a stock is going to be trending with a higher advance. Okay, it's going to be identified by a series of higher peaks and higher troughs. Let's take a look. Take a look at this CSX trade here. Notice that the trade is moving higher. We make a peak, and then what happens? We have a little correction, and there's your valley. In this particular case, your valley was almost flat. Over here in November was a little bit more of a valley, and you can see the idea of the peaks and the valleys. The peaks and the valleys. There is your trend. Now, in a downtrend, the cycle is going to be a trend of a stock's continued decline lower. This is going to be identified by a series of lower peaks and lower troughs. So we're going to take the very same basic idea. We're going to start with the peak all the way up here, and we're going to draw down to the next trough in March 2011. So we have the peak that came into play February 2011. The first trough came in March 2011. The next peak technically was halfway in March here, but this was the real one right here at the beginning of April. And if we were to mark all those together, it would end up looking like this. This is your basic peak and trough analysis. Now, it looks a lot like a line chart, doesn't it? What you're seeing by looking at that is you're seeing the basic structure of the trend. The basic structure of the trend. And this gives us the ability to start building our trend theory, the theory of how trends behave, etc. Okay? Now, when we get into a sideways trend, something that we also call a trading range, the trend of the stock's continued move up and down. I said that, I read that wrong from the way that I wrote it. Let me read it like I have it written. A trend of a stock's continued moves up and down while failing to register consistent higher or lower peaks or trough. Okay? So the peaks and the troughs are trading the same range as previous peaks and troughs. In other words, this stock's not going anywhere. I should have just used that as a bullet point. This stock's not going anywhere. All right, take a look here over on the right side of this Sears trade. Notice how the trade runs up to about $65, back down to about $45, back up to about $65. So we're not going anywhere. This is a trend of the stock with a matching peak and matching valleys or matching troughs, relatively speaking. Now, I could also, had I not quit my slideshow accidentally, I could also come in here and draw an additional line. Let me show you where it would come in. We could have drawn an additional kind of an internal line right in through here. And notice that I can easily line up these support levels very close there, right on here. And that would become an entire support zone, something that I just talked to you about a couple of minutes ago. You see how that would work? So a lot of times in your analysis, you might take I don't like to have lines everywhere if I can prevent it. Oftentimes I end up with more lines than I want, but I don't prefer to have lines everywhere. But what you might do is you might find an area like this and say, well, right in here I've got a zone, and you might just mark it on that portion of your chart, and that would make a whole lot of sense. I can certainly see why you guys would want to do that. Okay? Now, let's talk about the money. I've given you a lot of theory so far. We talked about the psychology of why trends behave. Then we talked about what the trend itself is and the peak and trough. Now, let's talk about the trend reversal, because this is where we make the money. The goal of you as a trader is to identify when a trend is reversing or when it's about to reverse, and to anticipate that reversal enough to participate in the following new trend. Your challenge, your goal as a trader is to identify when a trend is reversing or it's about to reverse and anticipate it enough to participate in the following new trend. The majority of our tools, and I'm teaching you, the majority of these technical tools are working to achieve this end, to achieve this goal. So when we get into chart patterns, we get into candlestick patterns, we get into indicators, all of the technical tools that I'm giving you are all working for this common goal of identifying trend change. If we can identify trend change, we understand better where we should be getting into and out of our trades. Okay? So how do we know when a stock is moving from bullish into a bearish trend? Well, here's what's going to happen. The stock is going to hit some type of a resistance level. Following the first sell-off, that is the first resistance point, following this first sell-off, a rally will generally follow. Not always, but generally speaking, we will get a rally. This rally will fail. And what happens after we have a failed rally? A sell-off will resume. When the failed rally, or I should say it just like I wrote it, when the rally fails to create a new high, we are set up for a bearish move. Say it again. When the rally fails to create a new high, we're set up for a bearish move, but it's not confirmed. The bearish trend is confirmed when a new swing low is created relative to the first wave of selling pressure. You should have those in your notes, so I'm not going to spend a whole lot of time on this slide. I want to get over here to the picture. Take a look at this trend. So you're in a bullish trend. You're riding up, and you got higher peaks, higher troughs or valleys, higher peaks, higher troughs. You get up here to the peak, you come down. Now, thus far, there's nothing wrong with this trend. The problem comes when you trade a little bit higher and you have a failed rally. See, this is your rally that does not get up to the previous high. That is your first warning that this trend could be reversing. Now, the next move is a bearish move that makes a new low relative to the previous low. Now we've got this second move. Once we have a rally, that is a confirmation that we've got a failed rally, a new lower high, and a new lower low. When this high peaks and starts to roll over again, that is your final third step of confirmation for the trend reversal itself. Now we've got an established bearish move. Now, a lot of you might be looking at that and saying, gosh, that's a big portion of the trend, and it's true. This is what we would refer to as classical technical analysis. The benefit of modern technical analysis is the benefit that we can use candlesticks, we can use chart patterns, and we can use indicators to oftentimes anticipate these setups. But I want you to understand the way that we qualify from peak and valley analysis, the way a trend has reversed. Because when we get into our chart patterns in the next class, you're going to find that a lot of these chart patterns are actually these reversals that are just the peaks and the troughs failing to confirm. Okay, some very, very valuable stuff that you're getting here, and it'll start to come together in the next class. Now, let's take a look at this in a real-life trade. Take a look at this first solar trade. We got a nice bullish rally that runs up here. Oops, come back. No, come back. Come back, slides. Come back. That's not what we wanted to do. There we go. There we go. All right, so we had this nice bullish rally here. The bulls are super optimistic, but suddenly the bulls that ran this thing up said, no, it's time to sell. We've got short selling that comes into play. Most of this is selling to close, though. You get the initial panic, runs down. We've got that same optimism that comes in, justifying the bullish move back up. By the time we get up here, we've got a lot of short selling that comes in, and we've got last minute people that are saying, hey, we didn't get to 180. I'll take 160. I'll take whatever I can get. The bearishness follows. Now, this trend was not confirmed as a reversal until this valley was created. A lot of times you guys say, Jeremy, how do you figure out where you get into a trade? And I'm always talking about breaking support and resistance. Well, look at this. We had a trend that was running through here. This was a lower high. This one back in March was definitely a lower high, but we had not broken the trend and we did not have a lower low until we got into April. Once we broke the trend, we had a new lower low, and now this bearish trend is in play. So now you can see the whole cycle as the whole thing moved over. Now, in the case of a bearish trade flipping to a bullish trade, it's basically the exact opposite. A stock's going to hit some type of a support level. Following this first rally, a first rally, a sell-off will generally follow. The sell-off will become overcome with optimism and buying will resume. When the sell-off fails to create a new low, we are set up for a bullish move. The bullish trend is confirmed when a new swing high is created relative to the first wave of buying pressure. That sounds complicated. It's really not. The picture is so much easier to understand than the words. We're in a selling frenzy. we hit a support, we have a buying move. What happens next? The sell-off comes in, but this sell-off does not make it all the way back down to the previous low. In other words, demand is picking up. You see this? So demand's starting to pick up. We have a weak sell-off. We're ready for a bullish reversal. The bullishness comes back in, and now that we've got a higher high relative to that first swing high that we had over here, we've got a new high. That's the first confirmation. We come back. Now we've got two higher lows. And now you see that this trend has been set up. Makes sense? Now, a couple of you, Stephen in particular, are asking questions about how this compares to a specific situation in a chart pattern. Stephen, we'll talk about that in the next class, because tonight's not really about chart patterns. I'm just wanting you to see how the peaks and the troughs all line out and how it affects the trend. Now, look at this in a real live situation here. Notice how we had a nice bearish trend from 68 down to 42. We create that support down here. We swing up, and this new high is just a little bit higher than the previous. In fact, it's almost flat. But watch this. We're not getting back down to the previous support levels. And you can see what happens here is we've got a sequence now of higher highs and higher lows. That sequence is a new confirmation or new signal of a trend reversal. Now, when we're moving from a trending stock into a sideways stock, it's sometimes a little bit harder to identify. In fact, it's often harder to identify. It feels a little bit confusing because you don't necessarily have clear highs and you don't necessarily have clear lower lows. But generally what's going to happen is after about 3 to 5 weeks, you should be able to start identifying that sideways move. And then once the range is identified, you can trade inside the range. I personally think the best way to do it is to trade the breakout of the range. That's the ideal. Take a look over here at this chart. This was on Sears. We just looked at it a moment ago. But notice we have our sell-off here. There's a nice low. As we come up, you have a lower high relative to the previous one. But watch this. The next low is pretty much right in line. And then you're back up to the same highs. And you're like, wait a second. What's the trick here? And as you can see, this trade is cycling back up according to this picture right here. And so you've got basically a sideways trend. We went from having a bearish trend into having a sideways trend. And now that you got a sideways trend, you have to adjust and trade it accordingly. Okay? Now, let's address the next element of trend. Remember, Charles Dow said that there's 3 levels of the trend. For those of you who know anything about Ralph Nelson Elliott, you know that he discovered that trends are actually much more fractal than that, and they can go up and down both directions either way for multiple levels. And so there's really a lot more than 3 levels to the trend, but we'll just go with the 3 levels for now. Okay, each one of these levels is going to have respective reversal signals. So you've got the primary, you've got the intermediate, and you've got the minor levels. You're going to get primary trend reversals, you'll get intermediate trend reversals, you'll get minor trend reversals. Every level of trend is going to have reversal signals. The challenge for you as a trader is to keep a perspective, trying to figure out which level of the trend you're actually trading and which reversals you want to watch for. So let's come over here to another chart and let's take a look at this picture. These are essentially your primary trends. Now, if you remember from the last class, a primary trend is going to be a year or more. So do these qualify? 05 to 2008, yep, that qualifies as more than a year. 2008, 2009, that's about a year. 2009 to 2011, that's about a year. Into 2012, that's, we're well on our way to a year. So yes, this particular chart that we've got here, these are the appropriate time frames for a primary trend. Okay. Now, inside this primary trend, you notice that you're not getting higher highs and higher lows particularly. That's because in order to identify the primary trend reversal, you pretty much have to look at the intermediate trend itself. Now, the orange line is representing the intermediate trend. This is going to be several months, a few weeks up to several months, okay? And what you can also notice in here is following this bottom over here in the far left, we had a high and a higher low, and boom, by now your trend is reversed. And each of these is higher highs and higher lows. Until we get up here in October 2007, where we peaked, we sold off, we had a low that appeared like it was still part of the preceding trend, but the new high said no. And now that we sequence through here, we're like, oh, there's a lower low. This whole thing is now reversed. And you see the idea down here at the bottom, same thing happened again in 2009. We have a low, we trade up, make a new swing high, a new swing low, and the next swing high becomes your new confirmation that, oh, this thing has reversed and we're going in the opposite direction. And now if you came all the way over here to 2011, you would say, there was my high, I come down, there's my low, I swing up, and oh, there's my swing high, I'm making new moves as I'm in the middle of a swing low here. And so these are primary trend being reversed, and in order to identify the swing highs and the swing lows, you probably need to be looking at, for a primary trend reversal, the intermediate waves. Does that make sense? You need to be looking at the intermediate cycles or intermediate levels of the trend to identify the primary trend reversals. Now let's go in another level. Let's look at the minor. And notice that the minor trends are the ones that are affecting the intermediate trend reversals. Does this make sense to you? Look over here. I didn't even draw all the minor trends because it was too small and I got bored. But look here. We had a peak. There's a low. There's a high. There's a lower low. By now, you know you're in an intermediate reversal. Now, here's a low. Here's a high. Here's a higher low. By now, you know you're in an intermediate bullish reversal. And so as you're trading, see, I don't really care what time frame you trade. Some of you want to trade long-term primary trends. That's fine with me. Some of you want to trade short-term minor level trends. That's fine with me. Some of you want to trade intermediate trends. That's fine. I really don't care. The thing that you've got to understand and recognize is if you're going to identify the trend reversal, you've got to be looking at the appropriate swing points and identifying which level of the trend do these swing points belong to. And so it's not that hard to identify them. I don't think you want to mark out every primary, intermediate, and minor trend on your chart. But what you can do is you can zoom way out. You can get a good picture of where the primary, intermediate, and minor level trends are. And then as you zoom back in, you say, well, I'm looking for an intermediate trend change. Let's look at these minor swing highs and swing lows. And as you identify those minor swing highs and swing lows, you can start to zero in on those trend reversals. Pretty cool, isn't it? Okay. Now, let's come over here and look at my, come on, there we go. Let's identify this question of which trend level matters. And I kind of just addressed this. But the reality is the peaks and the troughs of the intermediate are going to address the primary trend reversals. And the peaks and the troughs of the minor trend will be determining the intermediate trends. So if you want to identify your appropriate trend, whichever level you're trading, just continue zooming in on the smaller trends to address the respective level. Now, if you're doing day trading, this is essential because day traders are trading even smaller trends than minor trends. And so a lot of times you really have to zero in into the intraday chart. You know, sometimes you're getting into the 1 or the 5 minute chart to identify where the level of the trend is so you can really determine which direction you're going with the trade. How many of you think that this is informative tonight? You're understanding the ideas of the trend a little bit better. Here's what I want you to do, because I'm going to stop teaching you at this point. What I want you to do is I want you to practice these ideas, digest it. I'll get the video up probably tomorrow. We'll start rendering it tonight. It'll probably be done tomorrow. Maybe review the class, and here's what's going to happen in the next class. These ideas are going to come even better into your clarification because we're going to get into chart patterns. And what I just laid the groundwork for tonight is the idea of the psychology of why traders buy and sell in certain locations. So hopefully you understood tonight why traders buy and sell in certain locations. I explained to you the idea of trend identification with peaks and troughs. I explained to you that we're looking for new higher peaks and higher troughs or new lower peaks and lower troughs to identify trend reversals. In the next class, this is all going to come together as we start talking about price chart patterns. And what the chart pattern is a chart pattern is a specific type of peak and trough reversals. And when you see them, those patterns jump out like a ninja getting ready to jump you. And what they do is they tell you this stock's about to reverse. And it's really, really cool. So that's what we're going to do, picking it up in the next class. All right. What questions, comments, opposing views do I have while I read your action steps? Do your quizzes. Continue practicing your line drawing that we learned in level 1. Take note of how the peaks and the troughs behave and the relative nature of those peaks and troughs to the larger trend. All right, that's your homework tonight. So in other words, not a whole lot of new stuff. Just keep doing what you've been doing based on this stuff right here. All right, so looks like you guys really enjoyed tonight's class based on your commentary. That's good, because Paul, he looked at this and he's like, I don't know if that's going to be good. I said, I think it's going to be good. They're really going to like it. So I was right. Ken said, no, Greg says, why did you use the word valley? Well, Ken, here's the thing. Ken, Ken didn't say that. Greg asked the question. Why did you use the word valley? Greg, here's the curse that I have. I have read one too many books. And depending on who you read, these names are called different things. And so I use them interchangeably accidentally. Because across the industry, we could call it peaks and valleys. You have a peak and you have a valley, like a mountain valley. Or you can call it a trough. Or you can call it a swing. Swing high, swing low. We can call it all sorts of stuff. And so, Greg, I can't help myself. It's stronger than me. I have so many vocabulary words, and they just sometimes slip out. You can call it a trench. I don't care if you call it a trench. Sure, go for a trench. Yeah, Ken, who I accused of making the question, says, because a valley is the opposite of a mountain peak. Exactly, Ken. The valley is the opposite of a mountain peak. Thank you, Thomas. I appreciate it. Appreciate it. Ken says this is the best class so far. Wow, Ken. I appreciate that. Hopefully, Ken, the next class you will say the same thing. I like to try to up every class. You know, every class you say a little better than the last. Thank you, Minaj. Says, this is good old classical technical analysis explained beautifully. That was missing in the Legacy series. I appreciate that, Minaj. Appreciate that. All right, I tell you what, guys. I'm going to let the wonderful moderators that we've got wrap up a few individual commentaries, because you got a couple conversations going on there. And I'm going to look forward to teaching you Wednesday night, because Wednesday night we're going to be getting into chart patterns. So you guys have a great evening. Have a great, I said Wednesday. Shoot, it's Monday. I'm off. Today's already Wednesday. You guys have a great weekend. I will see you Monday night. And until then, happy trading. Good night.